Hello, beautiful people, and welcome to another brand new edition of the ITU Forex class. In this week's class, we're going to be talking about scalping. Okay, so out of all of the different trading styles there are, I particularly chose scalping for today's topic because it's one of the trading methods that a lot of beginners get drawn to because of how easy it is to actually get quick profits from. But it's also one of the most difficult for them to actually become profitable using because it entails having to juggle a lot of emotions. Okay, and that's why I want us to have the proper foundation for scalping, and then you are going to weigh the pros and cons for yourself and also make the decision whether scalping is for you, or maybe it's not just the kind of trading style that might be suitable for you. Okay, so without any further ado, let's dive right into it. Okay, so first things first, what in the world is scalping? What in the world is scalping? Well, to help you understand this question, we actually need to take a step back and talk about trading styles. Okay, because if we don't talk about trading styles, then you're not going to properly understand exactly what scalping is. Okay, so first things first, trading styles. What exactly are trading styles or trading personalities? Okay, so in the trading world, okay, there's what is known as trading styles. These are different type of methods that people choose to use to identify low risk high probability trading opportunities in the market. Okay, so one of them is scalping. But part of after scalping, we also have other trading styles. Okay, like day trading. Okay, we've got day trading. Apart from day trading and scalping, we also have another trading style, which is the one I use because it's the one I'm more comfortable with, and that is known as swing trading. Okay, we're going to talk about all of these styles briefly, and then we're going to dive into talking about scalping because that's what today's topic is all about. And after swing trading, we've got position trading. Position trading. Okay, position trading. If I can spell it correctly. Okay, good. So, first things first, all of these trading styles that you're seeing here, they differ. They have one thing in common, which is the time with which a trade which is taken is being held for. So, for example, when a scalper takes a trade, most times, because of the nature of how scalping is, he is usually going to be aiming for very, very quick little profits in the market. So, for example, a scalper might take a trade in the market and only aim for a profit of maybe 2 to maybe 5 pips. Okay? All he wants is to aim for those quick movements. And because of the nature of the type of trading he's doing, most of the times you'd see that scalpers need to find brokers who are going to give them very, very good spreads. In fact, some scalpers go as far as looking for brokers who would give them as good as zero spreads completely. They would prefer to pay commissions for their trading costs instead of paying for spreads because using spreads and pips to pay for their trading cost is going to eat into their profits. And most of the time, scalpers don't want that because they just want to get in and out of the market, quickly grab whatever amount of pips they want to, and then they're out. Okay? So most of the times, you'd notice that a scalper might only hold a trade open for anywhere from a couple of minutes to at most an hour. It usually, in fact, real scalpers in this game, they don't hold trades for anything close to an hour. They usually take trades once they get a little bit of profit, they're out of the market. And this is also one of the things that makes scalping so difficult because most traders who are not experienced with proper trading methodologies and the foundation of proper trading, when they take scalp trades, and instead of those trades to immediately move in their favor so that they can just bank the profits and call it a day, when those trades move immediately against them, because they don't use proper risk management, it tends to make them freeze and they don't close the trades as early as they should, which eventually eats into their profits. So you could see a scalper with win rates like 90% or whatever, but because his average losses are way bigger than his average profits, you'd see that he'll find it extremely difficult to make to become profitable. That's the inexperienced scalpers, okay? In this case, because the experienced scalpers, they know how the game works and their mental is in the right state. And so cutting losses quickly is nothing to them. It's not a problem, okay? So that out of the way, this is scalping, which is what we're going to really talk about today. Now, apart from scalping, we also have day trading, which is another trading style. But the difference between day trading and scalping is that for day traders, they tend to hold their trades for a little longer. So a day trader, by definition, is anybody who is going to open a trading position within a trading day, but he's not going to hold that trading position to enter into another trading day. So, for example, if this person finds, if a day trader finds a trading opportunity in the morning and he opens that trade, by the end of the trading session or by the end of the trading day, he would make sure to close that trading position, whether it be in loss or in profit, and call it a day. A day trader usually, as you can see from the word, from the name of this trading style, day trading, usually does not hold trades for more than 1 day. Okay, so a day trader could, hold trades for anywhere from a couple of minutes to a couple of hours, but at most, it's not going to be more than a day that a trade is going to be open for a day trader. Okay, and again, a lot of traders are drawn to this type of trading approach because the allure for scalping and day trading is that when you open those trades, mostly, by the end of the day, you know whether you've made a profit for that day or you haven't. Okay, it's as black and white as that. But again, I personally prefer, like I told you, prefer swing trading. The reason for this is, well, before I even talk about the reason, what exactly is swing trading? Swing trading, as opposed to day trading and scalping, is the trading methodology where traders hold trades open for anywhere from a couple of days to a couple of weeks at a time. So it's not uncommon for a swing trader to open the trade maybe Monday on the trading week and have that trade still open up until the end of the week, or maybe even up until the end of the next week, or next week, the beginning of next week. So it's not uncommon for a swing trader to hold a trade open for a day or a couple of days at a time. Okay, I personally prefer swing trading because it requires the least amount of time as when you compare it to day trading and scalping. Because one of the downsides of these trading styles is that because you're going to be looking for trade setups within a given trading day, most of the times you're going to have to spend some time in front of your screen looking for those trading opportunities and managing your open trades if you're a scalper, okay? Or even a day trader too. You might be stuck in front of your trading charts and looking for trade setups, managing those trades and all of that. Some people, that's okay with them, especially if they've got no 9 to 5 or, trading is their life and they just want to spend all of their lives in front of the charts. I don't. I personally have, other things to do with my time. I just prefer to, look at the charts maybe once or twice maybe a couple of times in a day. And it's not because I have to. It's because that's just, I just like looking at the charts. But based on my trading style, if I was strictly to trade based on my trading style, looking for even these trade setups would not, take up to 1 or 2 hours of my trading, of my time in a given week. Okay, so if I have a trade setup, I just place the trade and I'm out, and I have to do nothing else to manage those trades. Okay, so this is the least, for me personally, this is the least time requirement when you come. This offers the least time requirement for profitable trading as opposed to day trading and scalping, and that's why I really prefer swing trading. Okay. Most of us got into trading because of the financial freedom and also the time freedom. But you'd find it ironic that a lot of people, when they switch into trading and they get into learning how to trade and all of that, they quickly get lost in the rubbles and looking at the charts 247, looking for trade setups, managing emotions and all of that. It took me some time to get here, but eventually I found that I resonate more with swing trading as a trading style that fits my personality. My personality might not be the same with yours because you might prefer to sit in front of the charts looking for these trade opportunities and taking those trades. Anything that works for you, go for it. Okay, but I'm just giving you all of the. I'm just laying down all of the examples for you and then explaining them to you in a way that you're going to understand. So it's not uncommon. One other thing is that it's not uncommon for a swing trader or a day trader to open a trade risking anywhere from 10 to 100 pips, okay, as a stop loss for that particular trade setup. And if he's trading with a risk to reward ratio, which is a positive risk to reward ratio, meaning he's aiming to make much more than what he's prepared to lose on that particular given trade, then it's not uncommon for a swing trader to be aiming for profit targets of up to 300 or 200 or even 500 pips, okay, at a time. It's not uncommon. And that's why, because of the nature of this trading style, their trades usually tend to last for a couple of days to a couple of weeks, because it's not that easy for price to just make a 300 pip or 500 pip move within a given day, okay? It does happen, but it's not common. It doesn't happen often. But when you compare this with somebody who is doing something like scalping, it's not uncommon for price to move, 20 or 30 or 40 pips in a day. That's kind of common, especially in the Forex markets. And so because it's easy for price to make this type of moves in a day, for a scalper, it's easy for price to hit his profit targets, and also very, very easy for price to hit his stop losses. That's one of the things that I'm going to teach you, because one of the methods which scalpers use to properly trade the markets, okay? And lastly, we've got position trading. Position trading is kind of like a big brother to swing trading, because if a swing trader could hold a trade open for maybe a couple of days or a couple of weeks at a time, a position trader could hold a trade open for anywhere from a couple of weeks to a couple of months, okay? Because position trading, by virtue of how it is, it's more like investing. You open a trade and, you don't do anything. You could even have a trade open. A position trader could have a trade open for 5-6 months or even much more than that, okay? Most times you notice that position traders trade using the weekly or daily or monthly time frames, okay? And that's, that this requires the least amount of effort of chart analysis, chart time and everything. But again, remember, if you're using this type of trading techniques, if you're not refining your entries using the lower time frames, okay, if you're looking for your trade setups based on the higher time frames, then this is naturally going to give you, cause your trades to have a much wider stop loss, which will influence your profit targets and also influence how easy or hard it is for price to hit that profit target, and then how long you're going to last in those trades. Okay, so now that we have a basic understanding of the type of trading styles that we have, let's dive right into the scalping techniques which are going to help you, or scalping tips and tricks which are going to help you to become a much more profitable trader. Okay, moving on. So we're now on the charts, okay? And as you can see, this is the chart of the GBP JPY currency pair. This is also the 4-hour time frame of that chart. What I want to draw your attention to is the fact that this is the 4-hour time frame. And mostly, if you want to trade, if you want to be a scalper mostly, then it's not going to be in your best interest to trade with a time frame that is as high as the 4-hour time frame, except if you're using it to find your directions or whatever, and then you're using the lower time frames like the 1 minute or the 5 minutes to refine your trade entries. The reason why I say this is because look at this particular trade setup, for example. Assuming, as you can see, price is in an uptrend, and the reason why we've talked about market structure in multiple videos of the IT Forex classes, so you can just have a look at one or two of them to understand what I'm saying here. The reason why I say price is in an uptrend for this particular chart is because price is moving in what seems to be the market structure of an uptrending market, forming higher highs and higher lows, okay? So if, for example, let's say when you identified that price had this, price from this low, and then when it formed this high, it found it difficult to break below this low, and so this was a higher low. And eventually price came, broke above this resistance, and we kept forming higher highs and higher lows. So let's say you've already established that the direction of the trend is bullish here. And then you decided to take a trade setup in the direction of that trend. So at the close of this bullish engulfing candlestick, let's say you open the trade here with a stop loss here. And if you're risking 100 pips on this trade, you were going to be making, you were aiming for a profit target of, let's say, 200 pips. So this was a simple 1:2 risk to reward ratio trade. Okay. Now, the reason why I took the time to explain this is because if you were trading based on this chart, remember this is the 4-hour time frame. If you took a trade here, you're going to be risking something like 100 and something pips. There's no way, absolutely no way a scalper is going to take a trade and risk 100 and something pips. In fact, like I told you earlier on, most scalpers, when they get into the market, they only aim to make a profit of maybe 2, 3, 4 pips or 5 pips at a time. So in fact, because of this, because of their, quick get in and get out approach, when you talk to a scalper and tell him that, he's going to be risking 100 or something pips on the trade, it's in fact not at all, because apart from the monetary value of what he's risking based on the distance in pips or whatever, this would also imply that he's going to be in the trade for much longer. And most times, remember, scalpers want to be in and out of trades within very, very short amounts of time. Okay, so in this case, we are talking about something like 100 pips on this trade, and apart from that, this is the 4-hour time frame. So if you were to take this trade here, your stop loss was here. You can see if your profit target was somewhere around here, because you're risking 100 pips to make 200 pips. Even though price hit this stop loss for this particular trade setup, it would have taken around 16 bars. That's 16 4-hour candles. And so automatically, this would have been a swing trade, because based on this, 16 4-hour candles would easily be something like more than one trading day, or maybe 1 to 2 trading days. Okay, so this is not the style of a scalper. And that's why I said the other way to look at it is that a scalper could use something like this time frame, for example, and say, you know what, okay, we've established that we're in an uptrend. And so at the beginning of the day, he would have maybe noticed his market structure. This is a low, this is a high, price is now forming higher highs and higher lows. So maybe a scalper would map something like this. The reason why I'm mapping this is because if we go to the lower time frames, it's going to be easy for us to see it and look for trading opportunities, okay? So a scalper could do something like this and say, okay, based on the higher time frame, I know that from the market structure we've seen that price is now forming higher highs and higher lows. We are in an uptrending market. And so when I move to the 5 minutes time frame, what I will be looking for is a long trade opportunities. Any sell or short trade opportunities that I see, I'm not going to take them because I'm not interested, because I know that most of the times the trend or the movement on the higher time frame, dictates what happens on the lower time frame. And this is let me look for where I'm going to see this object list. The rectangle show, very good. So I'm looking for the rectangle here. Very good. So this is where it is. Now I'm going to zoom out of the chart a little bit. So you can see around here where I drew this rectangle, you can remember that we've already established that price is in an uptrend, okay? Now I want you to pay close attention to this, what you're seeing on the charts here. This right here, okay? And what am I drawing your attention to? These dotted lines, okay? I'm drawing your attention to these dotted lines that you're seeing here. These are known as period separators. So from all the price action that happened between this dotted line here, okay, is one trading day. It happened in one trading day. Okay, so every single day is going to be represented with these period separators, because this is just how it is, okay, a MetaTrader. So now that based on our gray chart, we've already a gray rectangle, we already know that we're in an uptrending market. Assuming when you came to trade, let's say somewhere around the middle of the day, this was the New York session or whatever, and when you came to trade that day, you saw this bullish engulfing candlestick, and so you took a trade here, okay, at the close of this candlestick, because you are only looking for buy trades. You're not interested in sell trades. And your stop loss was somewhere around here. Because this is the 5 minutes time frame. Remember, some scalpers even trade the 1 minute time frame. In fact, some even trade seconds time frame. I'm just using 5 minutes time frame here as a reference, as an example, okay? But you get the idea. Okay, so let's say because you identified the direction of the trend is bullish, and now at the beginning of the session that you're trading, you've seen that, you know, we have this bullish engulfing candlestick and all of this. You took a trade here, and from here to your stop loss would have just been something like around 20 pips. I know this is much, but I'm going to tell you why again, okay? This is one of the approaches, okay, that scalpers take. So you could have taken this trade here, aiming for maybe 5 or 6 pips. And then once price moves in your favor, you would have easily taken your profits from this trade, okay? Now, this brings us to what is known as the risk to reward ratios you're going to be using for the trades. I've talked about risk to reward ratios multiple times in the ITU. Risk to reward ratio, just like the name implies, is when you're risking a certain amount of money to make a certain amount of money in trading. That's just the thing that it implies, okay? So, for example, if we say you're trading with a 1:2 risk to reward ratio, this simply means that whenever you're risking one, and this one could be anything. So if your R multiple, you might hear traders saying R multiple. If your R multiple for your account, R represents 1% of your account starting balance, and you're trading with a 1:2 risk to reward ratio, this would mean that every single time that you risk 1%, you would be aiming to make a profit of 2%. Because your risk is 1R and your profit target is 2R. But what if your risk, your R multiple, is 2%, for example? This would mean that every time you risk 1, which is 1R, in this case, this would be 2%, you're aiming to make a profit which is 2 times your R multiple, which would, in this case, it would be 2 times 2, which would be 4%. So whatever your R multiple is, your risk to reward ratio is just going to reflect that you're risking that particular amount, aiming to make multiples of that amount. Now, this thing you're seeing right here is known as a positive risk to reward ratio. Most traders like myself who use trading styles like swing trading or position trading or whatever the case might be, even, in fact, some scalpers even do it, but it's just not that common with most scalpers, okay? Most of the times, you'd see that we trade with a positive risk to reward ratio, meaning whenever we're risking a small portion of our account, we're aiming to make a profit which is multiples of what we are risking. But there's also another style of trading which is adopted by more scalpers, which is known as negative risk to reward ratio. This negative risk to reward ratio is when you are risking more to make less. Okay? Get this again. You're risking more to make less on every trade you take. So, for example, a trader could be trading with a risk to reward ratio of 2:1. He's risking 2. So, for simplicity's sake, let's say the R multiple for this trader is 1%. So, every time he takes a trade, he's risking 1% of his account capital to make half of that, because he's risking 2 to make 1. So why am I mentioning negative risk to reward ratio? The reason is because by virtue of how scalpers trade, most of the times they want to get into the market and quickly take profits off of the table. And so they usually would want to have their stop loss a little further from where price is, because they want to avoid getting stopped out of their trades by just any slight noise in the market. And so when the market moves in their favor, for just as much as they want in profit, they will quickly grab that profit while also giving enough room to the trade so that they don't get stopped out by random market fluctuations. Okay? But the problem with trading with a negative risk to reward ratio, and why you hear most trading mentors or trainers or coaches don't recommend it to a lot of beginning or struggling traders, is that it will make you focus a lot on winning. And that's what we want to draw your focus off of. Because when you're trading, no matter which trading strategy you use, you're not going to win 100% of the trades you take. And so the easiest way to become a profitable trader is to ignore the outcome of your trades. And it's much easier to do that if you're trading with a trading strategy or a trading methodology that uses a positive risk to reward ratio. The reason is because if, for example, you're trading with a strategy that has a 1:3 risk to reward ratio, meaning every time you risk, for example, 1% of your account's capital, you're aiming to make a profit of 3%. In this case, if you were to take something like 100 trades, okay, and after taking those 100 trades, your win rate was only, let's say, 30%. This would mean that you only won 30 trades out of the 100 trades you took, okay? and you lost 70 trades out of the 100 trades you took. But in this case, every time you lost a trade, you only lost 1%. So your gross loss is 70%. But your gross profit would be 30 times 3, which would be 90%. So in this case, 90%, which is your gross profit, minus 70%, which is your gross loss, you'd still end up with a net profit of plus 20%. And this is even because you still have this is even though you have a 30% win rate. So using this type of positive risk to reward ratio, where you are risking small to make much larger than what you are risking, is going to help you to, because you know that the math is in your favor. Even if you were to lose more trades than you win, you're not going to be bothered. But the problem with trading with a negative risk to reward ratio is that it's going to place the emphasis on winning more. Because with a negative risk to reward ratio, if you're not careful, you could have a win rate of 80% or 85%, but because the losses from your losing trades are much larger than the profits from your winning trades, then you would still be at maybe break even or even find it difficult to make profits. And that's one of the reasons why, if you want to become a scalper, my recommendations to you would be to first trade with the other trading methodologies, backtest strategies with the other methodologies. When you have your mindset in the proper frame and you understand how to maneuver risk management and all of these other concepts in trading to become a profitable trader, then you would have built the mental fortitude and the discipline and all of the things you need to be able to function properly in a scalping trading environment. Okay? Then you can use, negative risk reward ratios to your favor. And again, I want to clarify here is that scalping does not mean that any scalper you see has to trade with a negative risk reward ratio. Absolutely not. In fact, there are scalpers out there that trade with positive risk to reward ratios. And this particular trade setup that we used as an example, you could easily be trading as a scalper with a risk to reward ratio of maybe 1:3 or 1:4, for example. So let's say when you saw this trade setup, you were risking 1% of your account's capital per trade. But then you're aiming to make a profit of 4 times what you're risking. Now look at this. Price wouldn't have stopped you out, even though it attempted to, but then it would have easily hit your profit target. Okay? Maybe it had to go into the next day, but eventually price still hit your profit target. So you would have been risking 1% and you would have made a profit of up to 3%. Okay, so you just know how to work out the numbers. You just need to know how to work out the numbers to be in your favor, because if you're trading with this type of method and you're trading with a positive risk to reward ratio, even if you lose a lot of trades, which is common in trading, I want you to know that you cannot escape losses. Okay, even if you do that though, if you're using this type of proper risk management and positive risk to reward ratios and all of that, losses would not even bother you at all. You don't need to know what's going to happen to make money in this business. Okay, losses are not going to prevent you from making money as long as you do the right thing. And the right thing is proper risk management, always, coupled with an edge that will give you an unfair advantage in the markets. Okay, and this pretty much brings us to the end of this week's edition of the ITU Forex class. And before we wrap up, I would like to quickly draw your attention, guys, to the other opportunities which we have in the company, which are built to cater for traders who don't have time to sit in front of their charts 24/7 looking for trade setups and trading. Okay, maybe you're a busy trader, maybe you're somebody who is trying to earn some profits while you're learning how to trade manually. Then you could have a portion of your portfolio being traded by our bots, which we've got a lot of them. We've got the ABT, we've got the SBT, we've got the ITU Gold Mine, and we've got the Gold Mine Pro. Okay, and all of these are designed to find trade low risk, high probability trading opportunities for you, properly manage the risk on those trades for you, even while you're asleep, even while you're away from the charts. Okay, so if you're interested, please reach out to us on the socials or drop your questions or comments in the comment sections. Okay, and we'll be more than glad and more than happy to assist you set everything up step by step. Okay, so once again, thank you very much for taking time out of your busy schedules to come out to these trainings and all of that. We look forward to seeing you guys in next week's edition. Have a wonderful rest of your trading day. Cheers and God bless you.